Hey guys, it's a new month, so you know the drill. Today, I share our Tfsa dividend income for the month of November. Let's do this. Before I jump into who paid us and how much, let's glance at our portfolio's dividend calendar. January, April, July, and October are the heavy months, and February, May, August, and November are the light months. The other months land somewhere in the middle. What are the biggest dividend paycheck months for you? Please let us know in the comments below. In November, we received dividends from the following 5 stocks. Like usual, we'll go through each paycheck we received, adding up our totals along the way. And hey guys, if you want to follow our trades live on a daily basis and hear our rationale for some of our purchases, you should totally download Blossom Social, a completely free financial app. It's like Instagram married Twitter and had a baby. You'll earn $5 on sign up when you use the code Mr. Financial. Just click on the link in the description box if that's something that interests you. Now for our paychecks, our first dividend at $23 is our one closed-end investment fund we have, Canoe EIT Income Fund. It provides us with 4% of our yearly dividend income. EIT has consistently paid out 10 cents a month for as long as I've owned it. The more the years go by, the harder it is to get rid of this income fund because of how well it has performed. Thank you, Robert Taylor, for doing such a stellar job at beating the market. Our next dividend received was $35.67 from a monthly payer, Pembina Pipeline Corp. It pays us 6.2% of our yearly dividend income as one of 3 in the oil and gas midstream pipeline industry. This stock is trading below its 5-year average yield of 5.7% with a yield of 5.3%. It recently raised its dividend 3.6%. It has a 5.8% 5-year CAGR on its dividend. It is trading up 9% on the month and is only 9% off of its 52-week high. Pembina Pipeline has outperformed the market drastically, up 24% year to date, not including the dividend. With the economy still roaring along, it looks like oil and gas continues to flow at its regular rate despite the troubles with the Chinese economy. Maybe the oil cycle will hold out a little longer. With this paycheck, we're at $58.67. Before we continue, please smash that like button to spread this video to as many Canadian dividend growth investors as possible. It really helps our master, the YouTube algorithm. And if you want to follow our journey in our TFSA, why not hit that subscribe button and notification bell so our videos annoy you to be watched each and every week. Now back to what you came for. Big, fat, juicy dividends. Next, we were paid $45.31 in distributions from SmartCentres Real Estate Investment Trust. They now provide us with 7.9% of our forward annual dividend income as one of 2 stocks in the real estate industry as a retail REIT. They are trading above their 5-year average yield of 6.1% at a yield of 6.7%. SmartCentres' unit price increased 3% on the month. It is below my yield on cost, so I'll be adding to this position little by little. They have a 5-year dividend growth rate of 2.2%, matching inflation, but have not increased dividends since 2019, a few months before the pandemic. After 3 paychecks, we break through $100 at $103.98. For our 4th paycheck, we have our only monthly financial payer, First National Financial. We receive $48.96. FN provides us with 8.7% of our annual dividend income. First National has been running up this month, up 6%. Currently, it provides a 6.6% yield. With a 5-year average yield of 5.6%, this is technically undervalued using this metric. I'm comfortable adding to this position despite the general sentiment about the real estate market in Canada and the rising cost of borrowing. As I always say, I like to accumulate fundamentally strong companies when they're out of favor or their industry or sector is as a whole. Last month, it declared a small 2.1% dividend increase, bringing it to 20 cents a month. That makes it 1 decade of dividend increases and a 5-year DGR of 6.6%. This brings us to $152.94. And now, for our largest holding, RioCan Real Estate Investment Trust. They paid us a distribution of $62.12. This company provides us with a massive 10.8% of our forward yearly dividend income. It has a 5-year average dividend yield of 6.16%, which is drastically higher than the current yield of 4.9%. This is mainly due to RioCan slashing the dividend by 33% back in 2021. The most recent dividend increase was 6.3% this year, or half a cent a month. RioCan has also been on a tear in November, up 11% at one point, but still ended the month up 8%. What a roller coaster this year has been. I'll keep dripping this all I can at this great valuation, 25% below the NAV of about $26. This is a core holding for us. Q3 earnings were good, and they reaffirmed 2022 FFO per unit growth guidance of 5 to 7%, and is expecting to be in the higher end of the range. The FFO, or funds from operations payout ratio of 56.7%, was in line with the long-term target range of 55 to 65%. We can now anticipate another modest dividend increase next year, inching closer to the previous distribution of 12 cents a month. After all 5 paychecks, our grand total is $215.06, the lowest we've had in a few years. Wah, wah, wah. Our top 3 dividend payments accounted for $156.39, or 72% of the $215.06 of dividend income for the month of November. This was almost $100 less than the previous year because of selling 30% of our portfolio in September. As we grow the portfolio, the top 3 should account for less of a percentage of the monthly income. I never want to be too dependent on any one company to help our portfolio grow in the event of a dividend cut. As you can see from the portfolio breakdown, no one industry or stock dominates our dividend income. Now, a huge part of our dividend income growth are the dividend raises we receive. We had 2 dividend increases this month. This makes a fabulous streak for us of 4 consecutive months. TELUS increased its quarterly dividend payout by 7.2% to 35.11 cents. That's an inflation-beating increase, baby! With this, we added $18.41 to our forward annual dividend income. Enbridge increased its quarterly payout by 3.2% to 88.75 cents. That's the 28th consecutive annual dividend hike for ENB. With this, we added another $15.95 to our forward annual dividend income. These 2 increases are the equivalent of adding over $859 of cold hard cash at a 4% yield. Isn't dividend growth investing jaw-droppingly beautiful? So far this year, we have received $7,823.49 in dividends with a yield on cost of 7.39%. Our forward annual dividend income has dropped from $9,500 to $6,878 after selling off 30% of our portfolio in September. We expect our dividend income to continue to snowball as we drip and try to max out our Tfsa again next year. I think of my dividends as my little minions that work hard for me when I can't. With our minions working hard for us, we can forecast where we'll be in about 10 years. We hope to outpace this forecast as the Tfsa contribution room grows in the future. And it was announced in November. The 2023 contribution limit is now $6,500 for more compounding growth potential. Thank you so much for watching, subscribing, and hitting that like button. Until next time, I'm Mr. Financial.